Welcome back to another deep dive. Today's Monday, February 2nd, 2026. And the Cohort, look, let's just address the elephant in the room. If you opened your portfolio app this morning, you probably, well, you didn't love what you saw. It's pretty ugly out there. We're looking at Bitcoin hovering right in that, what, $77,000 to $81,000 range.
It just definitely a sea of red. There's really no sugarcoating the price action itself.
It just feels heavy. I mean, we are talking about a roughly 30% haircut from that all-time high, the $126,000 we hit back in October.
Which was only a few months ago.
Exactly. But it feels like a lifetime ago, doesn't it?
Yeah.
And the mood on social media, it is grim, just doom and gloom everywhere.
It is, and that's actually where we have to start, because if you're only looking at the price candle on your screen, you are missing the single biggest contradiction I have ever seen in this market.
That's a big statement.
And I don't say it lightly. We are witnessing what analysts are calling the January divergence. On the surface, yeah, the market looks like it's collapsing. The fear and greed index, it's plummeted to 32. That is deep in fear territory. We're seeing retail investors, the smaller wallets, less than 0.01 Bitcoin. They're capitulating.
They're sculling off.
They sold about $11.66 million worth of Bitcoin just recently. They are heading for the exits.
Okay, so the little guy is panic selling. That fits the narrative. You see it on Twitter. Everyone's screaming the bear market is back. But you're saying that's not the signal to watch.
It's the noise. It is absolutely the noise, not the signal. Because while retail is running out the front door, the mega whales, and we are talking about entities holding more than 10,000 Bitcoin, they have just executed their largest monthly net purchase in 13 years.
13 years. Wait, hang on. Let's pause on that. 13 years takes us back to, what, 2013?
2013.
That is practically the prehistoric era of crypto. So you're saying big money is buying more aggressively now than since Bitcoin was trading for, like, double digits.
Exactly. And that is the mission for this deep dive. We have to unpack why. Why is the price dropping while the smartest, deepest pockets in the room are buying billions of dollars worth of this asset? We aren't just looking at a dip here. We're looking at a huge structural shift.
So the game is changing while everyone is just distracted by the scoreboard.
Precisely. The thesis today is that we are moving from that old 4-year cycle, the boom and bust,
Right.
into what people are calling the institutional era. So we need to look at the on-chain data, this wealth transfer. We have to look at how the ETFs are physically changing the market. And maybe most importantly, the regulatory plumbing, specifically something called the Genius Act that's giving these whales all the confidence.
And we can't forget the macro stuff, the Fed's pause, and that crazy situation down in Venezuela.
Right, the geopolitical shock. We'll get to all of it.
Okay, let's start with what you call the Great Siphon. You dropped a massive stat on me about the sheer volume here. Break that down for us. Who is buying and just how much?
So when we say mega whales, we aren't talking about like a wealthy dentist day trading on his phone.
Right.
We're talking about massive entities, hedge funds, corporate treasuries, maybe some early adopters who've become institutions themselves. In January 2026 alone, this one group added 270,000 Bitcoin to their stacks.
270,000 coins.
In 1 month.
In 1 month. Wow.
At current market prices, you're looking at roughly $23 billion in buying pressure. And just to put that into context, this group now controls about 15.7% of the total Bitcoin supply.
That is just a staggering amount of money. But here's the part I always struggle with, and I bet a lot of listeners do too. If they bought $23 billion worth, why did the price go down?
Yeah.
I mean, Econ 101 says if you buy that much of something, the price should be skyrocketing.
That is the million-dollar question, isn't it? It all comes down to how they're buying. See, a retail investor usually market buys. They just smash the green button, take whatever price is there.
And that pushes the price up.
Drives it up fast. These whales, though, they're strategic. They use limit orders. They are, in effect, catching the falling knife, but they're doing it with industrial-grade gloves.
So they aren't chasing the price up. They're setting a floor and just letting the panic sellers dump right into their bids.
Precisely. They are acting as a backstop. We saw it so clearly on the charts. Whales were observed closing short positions and just absorbing all that selling pressure, specifically near $89,000 and then again at $81,000.
Defending those zones.
They're defending them. They're essentially saying, go ahead, we will take everything you have at this price.
You highlighted a metric I'd never heard of, the Accumulation Trend Score. It sounds like a weather report for money. What's it telling us right now?
Think of it like a thermometer for conviction. A score of 0 means everyone is dumping. A score of 1 means everyone is buying. Right now, if you look at the broad market, you, me, the average trader, the score is, well, it's neutral to negative. It's hovering around zero point 0.3 or zero point 0.4.
Which totally matches that queasy feeling in the market.
Right. But if you filter the data and only look at that mega whale cohort, their accumulation trend score is flashing between 0.85 and 0.95.
So it's maxed out.
It is practically maxing out the meter. They are not just nibbling, they are aggressively accumulating.
It really feels like a quiet accumulation, though. It's not flashy.
And that's backed up by the flow of money moving off exchanges. Now, there was one scary headline on January 20th, I think you saw it, about a $400 million deposit spike onto exchanges.
Yeah, and people freaked out. The thinking is you move coins to an exchange when you're about to sell.
Correct. And that panic makes sense. But it was a blip. If you zoom out, the overall trend is massive outflows. We saw one specific 4-hour window just recently where 19,700 Bitcoin were withdrawn.
Withdrawn to where?
To cold storage.
So offline vaults, deep freeze.
Gone from the liquid market. And this creates what we call a supply shock. Imagine a grocery store. The shelves look full, but the warehouse in the back is completely empty. The moment a rush of buyers comes in,
His shelves get cleared instantly, and there's nothing left to restock with.
that is what's happening to Bitcoin liquidity right now.
Which sets the stage for just massive volatility to the upside if demand ever kicks back in. But speaking of volatility, we have to talk about how the character of this asset has changed. We're 2 years into the spot ETF era. Bitcoin doesn't really behave like it used to, does it?
No, it is a completely different animal. Before the ETFs launched in 2024, Bitcoin was wild. Volatility was averaging around, 4.2%? It was a lottery ticket. Now here in 2026, that volatility has dropped to 1.8%.
That's a huge drop. Then getting closer to like large cap tech stock territory. Is it getting boring?
Boring is good for big money. It's maturing. And the most fascinating data point that proves this is the trading hours. In 2021, Bitcoin was a 247 casino.
Right. Weekends, nights.
Most of the action was on weekends or in Asian trading hours now. 57.3% of all trading volume happens specifically during U.S. stock market hours.
So it's become a 9-to-5 asset. It wakes up when Wall Street wakes up and goes to sleep when the closing bell rings.
Basically, it has been integrated into the traditional financial machine.
Okay, there's a misconception I want to clear up. When we say institutional era and ETFs, I think people picture, guys in suits at Goldman Sachs buying for their own accounts.
Yeah.
But the data shows something else.
This really surprised me. The data shows that 80% of the money in these ETFs is actually retail capital. But, and this is the key, it's retail capital flowing through institutional rails. It's people buying Bitcoin in their IRAs, their 401ks, their brokerage accounts.
So it's not just hedge funds. It's grandmothers and retirement planners.
Exactly. I mean, BlackRock's IBIT is still the leader. It's got over $70 billion in assets, which is just a monster number. But we're even seeing a shift there. Grayscale's mini trust, the BTC ticker, is eating up market share.
Why is that?
Because they lowered their expense ratio to 0.15%.
Everyone loves a bargain on fees. But we did see some money leave the ETFs recently, right? About $1.1 billion slowed out in late January. To me, that sounds like panic.
It looks like panic on the surface, but analysts are calling it repositioning. You have to remember, these large portfolio managers, they act on signals. When the Federal Reserve changed its tune, which we'll get to, these managers have to rebalance. It wasn't a get me out of crypto forever move. It was an adjust the risk weighting move.
Okay, let's connect the dots. We have whales buying the dip, ETFs stabilizing the price. But why are they so confident? Why buy $23 billion now? You mentioned regulatory plumbing. This sounds like the boring part, but you're arguing it's actually the main event.
It is absolutely the main event. Look, you cannot have a true institutional era without clear rules. Big money hates uncertainty more than it hates losing money. And for the first time, the U.S. has provided a real rule book. The biggest piece of this puzzle is the Genius Act.
Right, which stands for, let me see, Guiding and Establishing National Innovation for U.S. Stablecoins, signed back in July 2025.
Right, and the implementation is scheduled for July of this year, 2026. This act regulates stablecoins, those dollar-pegged tokens that act as the poker chips for the entire crypto casino.
So why is this specific law-making whales bullish on Bitcoin? It's not even about Bitcoin.
Because it legitimizes the rails. The act requires stablecoin issuers to hold one-to-one reserves in cash or U.S. treasuries. It basically says, if you issue a digital dollar, you must have a real dollar sitting in a vault. That makes the system safe for massive amounts of capital to enter and exit.
But there's a catch, isn't there? The no-yield clause.
Yeah, that's right. It prohibits paying interest just for holding stablecoins. This was a concession to the banks. They didn't want unregulated tech companies acting like high-yield savings accounts. But the trade-off is worth it because it provides a clear federal standard. It turns a fragmented gray market into a unified white market.
And then there's the SEC. For years, the SEC was basically the eye of Sauron for crypto, just staring at it, waiting to sue someone. But under Chair Paul Atkins, the whole vibe has shifted.
It's a complete 180-degree turn. Under what they're calling Project Crypto, the SEC is working on an innovation exemption. It's basically a safe harbor, and we're expecting it early this year.
Explain safe harbor for someone who isn't a securities lawyer.
It just means companies can experiment. They can launch a token or a business model and test it for a set period, maybe 3 years, without the constant fear that the SEC is going to sue them into oblivion for not complying with rules from the 1930s.
So it's a sandbox. Go play, don't hurt anyone, and we won't fine you.
Exactly. And the explicit goal here is to reshore crypto innovation. For the last 5 years, all the cool stuff was being built in Dubai or Singapore because the U.S. was just too hostile. Now the U.S. is saying, come home.
And that matters for the Bitcoin price because
Corporate treasuries and pension funds are conservative, we now have 273 companies holding Bitcoin on their balance sheets. They cannot invest in a legal gray area. With the Genius Act and this new SEC posture, that gray area is turning black and white. And that is the green light for the $23 billion inflow we just saw.
Okay, so the stage is set for growth.
Yeah.
But we can't ignore the headwinds. I mean, why did the price drop 30% in the first place? It wasn't just technicals. We had some serious macro issues.
It was a perfect storm of bad news. First, the Federal Reserve. Late last year, we got those 3 rate cuts, the market party.
Everyone thought cheap money was back.
Right. But in January, the Fed signaled a strategic pause. Rates are now holding at 3.5 to 3.75%. And markets hate that. They wanted more cuts. So money rotated out of risk assets like crypto and into safe assets. But here's the fascinating part. Retail investors went looking for a hedge, but they didn't choose digital gold.
They didn't choose Bitcoin.
They chose actual physical gold.
Gold had that massive rally, right? Up to around 5,200 an ounce.
It broke records. And this tells us that when push came to shove, the retail crowd reverted to the old boomer hedge. They sold Bitcoin to buy gold. And that just sucked liquidity right out of the crypto market.
And then just to add to the chaos, we had a literal black swan event, the Venezuela situation.
Yeah, you can't model for this in a spreadsheet. The news about the capture of Venezuelan President Nicolas Maduro by U.S. forces, it sent shockwaves through the global markets.
I get why that shakes up oil markets or Latin American bonds, but why did Bitcoin take such a direct hit from that?
Because of what Venezuela is rumored to be holding, it's been an open secret for years that the Maduro regime was bypassing sanctions by accumulating Bitcoin, possibly hundreds of thousands of coins in state reserves.
Ah, I see. So the market panicked, thinking the U.S. just captured the guy who holds the private keys.
Exactly. The fear was that the U.S. would seize those assets and just dump them on the market, or that regime loyalists would panic dump them to flee the country. It introduced massive uncertainty about a huge chunk of supply hitting the market all at once.
But going back to our main theme, the whales didn't care?
No, they saw that fear as a discount coupon. They bought the geopolitical dip just like they bought the Fed dip.
Before we wrap this up, I want to check on the rest of the ecosystem. Usually when Bitcoin bleeds, the altcoins, the smaller tokens, they get absolutely murdered. Is smart money touching anything else? Or is this purely a Bitcoin safety play?
It's actually a broader infrastructure play, which is really interesting. We are seeing whale accumulation in some very specific assets that tell a story. Look at Chainlink, LANK.
That's the data layer, right?
Yeah.
Connecting blockchains to the real world.
Exactly. While retail was panic selling LANK below $13, whales added 16.1 million tokens. They are betting on the plumbing. We also saw it with Onyx Coin, XCM, about 290 million tokens scooped up. The strategy seems to be secure the supply of the infrastructure tokens first, and then worry about the price later.
What about fun stuff, like the meme coins? Is Dogecoin dead?
Surprisingly, no. The price has been consolidating, which means it's pretty boring, but the holder count for wallets with more than 10,000 Doge has remained rock solid. They are not selling.
That's some high conviction for a coin with a dog on it.
It is. It suggests they're betting on it eventually being used as a legitimate payment rail, maybe on X or somewhere else. It's not just a joke anymore to these big holders.
So let's try to pull all this together into a coherent picture. If you just look at the chart, Bitcoin's down 30%. It looks terrible. But if you look at the flows, You have the largest whale buying in 13 years. You have the Genius Act providing legal clarity in just a few months. And you have ETFs stabilizing the volatility.
That's the summary. And this all leads to a theory that's gaining a lot of traction, the death of the cycle.
The idea that the famous 4-year boom and bust cycle is over.
Right. We might be done with the era of 80% crashes and 1,000% pumps. We could be moving into an era of steady, boring institutional accumulation. The asset is just becoming a standard part of a diversified portfolio. It's becoming normal.
Which sounds boring, but in finance, boring is usually where the real generational wealth is preserved.
Exactly. The volatility is dampening, but the floor is rising.
So here is the thought I want to leave everyone with. We've established that retail investors, the regular folks, are panic selling because of the price. And we've established that they are selling to the mega whales and the institutions, the exact entities that crypto was originally supposed to make obsolete.
It's the ultimate irony, isn't it? The little guy is selling his ticket to the moon to the hedge fund manager he claims to hate.
Whales now hold 1.3% more of the total supply than they did just 1 month ago. The Genius Act comes online in July. If the institutions are sucking up all this available supply now, while the price is low, who are they going to sell to next?
Or maybe the scarier question for those who sold is, will they sell at all? If this is a wealth transfer into corporate balance sheets and pension funds with 30-year time horizons, those coins might be going into vaults that don't open for decades.
A sobering thought for anyone pressing that sell button today. That does it for this deep dive. Keep your eyes on the flows, not just the candles. We catch you next time.